Hello, everyone. So let's look about the group accounting on how you can adjust the income statement items of a subsidiary. So first of all, you have to understand the meaning of a subsidiary. So a subsidiary is where a parent company acquire more than 50% of equity shareholding interest. So long as it's no more than 50%, now that means it is a subsidiary and the parent is controlling more than those percentages. So when you're adjusting the income statement, first of all, you have to understand how they structure the income statement you are given, because it will always start with the revenues or the value of your sales. So how do you adjust the revenues? So you just go to the question and you see the value of your parent. How much are you given for the parent? So the value of the parent will be given. You put it there. You check the value of subsidiary. You add it to the value of the parent. Add it to the value of the parent. Then you check and additional information. If the two companies make some trades, the intergroup sales, or there's one is selling to another one something, that amount should be eliminated. So you less intergroup sales. So that value will be given and additional information. You deduct it so that you get the value of your sales. So whatever that will be remaining is what will be what? So the value remaining is the value to be what? To record? To record. So that is how you can adjust your revenues in a simpler way. Then I can try to check the value of the cost of sales. So how can you adjust the cost of sales? You also pick the value of the parent. You add the value of the subsidiary. Then you check if there is depreciation. So you add the value of depreciation from your assets, the PPE. Then you less intergroup cost of sales. Intergroup cost of sales, you less. So the value of these cells will have a certain item known as the UPS. So that UPS should be eliminated so that you remain with the cost on that amount. So that whatever remain here is what you record. So this is what we record under the sales, and this is what we record under the cost of sales. Then from there, we start analyzing the expenses. So the first expenses will be given the distribution costs. Distribution costs. So under the distribution costs, again, you have to pick the value of the parent and the value of the subsidiary. You combine them together. So that one, there is nothing again you can add, so that you can just get the balance to record the total. So that is how you can adjust your distribution cost. Then the next item is the administrative costs. Or admin expenses. So this one, again, it is just the parent, subsidiary, the addition of the two, combination. So the value of the parent and the value of the subsidiary. So the total, you add them. That is how you adjust your admin costs. Then I check if you're given the finance costs, the interest. So finance cost. Finance costs. So under the finance cost, you also check how much is the finance cost for the parent and how much is the finance cost of the subsidiary. You combine them together. So that gives you the value of your finance cost. So that now you can now get your profit before tax. But before you get the profit before tax, check if you're given the goodwill and the goodwill has some impairment. So that if goodwill arising on acquisition of a subsidiary is impaired, the impairment will be recognized in the income statement as an expense. So you have to deduct it after calculating the goodwill. You impaired the rate given, then that expense to be recognized in the income statement. So that is now you can now get the profit before tax. Then after getting profit before tax, that means you are now going to the taxes to remove them. So how do you adjust the income taxes? Both from the parent and the subsidiary. So you just do the same, the parent value, add the subsidiary value. The parent and the subsidiary, the combination of the two. Then now from there, you can now get your profit after tax. So once you get your profit after tax, remember this amount now belongs between the parent and the subsidiary. So that means you have to reduce it so that you give the subsidiary the portion of their share from the profit after tax. So that means you will have to less share of profit after tax to non-controlling interest. We call it NCI. So the NCI will be given how much based on the rate that they are remaining with. If the parent acquire 80%, that means they will have to remain with the 20, so the 20 will be their share. So how do you get that in that non-controlling interest? So NCI to record in the income statement. So I'll go to my income statement, then I check the value, the profit after tax of the subsidiary. So that the value that I have to check. Then I check the value of my depreciation. So I less depreciation. Then I also less UPS and realized profit on stock. UPS. Then that one will give you a certain figure down there. That figure I multiply by the share of NCI. So I multiply by NCI rate. E.g., if they're controlling 20%, I multiply by 20%. So I have to check how much is the rate that they are controlling. So that value, I deduct it from profit after tax. So once I remove it from profit after tax, I'll get profit attributable to parent. I'll get that amount there. Profit attributable to the parent. So this profit attributable to the parent. I'll check if the parent gave themselves dividends during the year. So I less dividend paid to parent shareholders. So I have to deduct that one. So after deducting that one, I'll get profit for the year. I get profit for the year. So that from the profit for the year, that means I have to take it to the retained earnings account. So that I add retain profits brought forward, so that I get my retained profits carried forward to my in balance sheet. So those are the how you can adjust those income statement items of a group company. So, and we are dealing with the subsidiary, there are certain things that you need to check. So information to check, so that things doesn't go wrong. Information to check. Number one, financial year end. The year is ending on when? Because we prepare the financial statements at the end of the year. That means after 12 months trade. So you check the financial year end so that it give you can calculate backward, 12 months backward, so that you get financial year start. You can call it financial year end date. So the benefit of analyzing a financial year is now you can be able to check the acquisition took place on which date of the financial year. So that means that one now, after that one, you check the acquisition date. Or the acquisition took place on the beginning of the financial year. That means if it is ending of December, that is start on January. So that means they'll tell you that they traded during this financial year for 12 months. Or if the acquisition took place in the middle of the financial year, so that you know how many months they are traded from the post-acquisition. So once you know the date of acquisition, that means now income statement items of a subsidiary is apportioned by number of months from date of acquisition to year end. So for example, that if the acquisition is 6 months, just for example, that means if you have the revenues I'll pick the parent full. Then I add the subsidiary. Well, for the subsidiary, if it is maybe 500, I apportion it by 6/12. So you have to be keen with the financial year and the date of acquisition. Then I can less your intergroup cost, intergroup sales. So that is the benefit of checking the financial information. When is the financial year is ending? When is the acquisition took place? So that you don't go wrong to the subsidiary items. If you don't check that one, the information, all of them will be wrong. So that is how you can adjust your income statement items of a subsidiary. So you can just do a recap. So for the revenues, I pick the value of the parent, I add the subsidiary, I less intergroup sales. I go to cost of sales, the parent, I add subsidiary, I check depreciations for revaluation or UPFA, I calculate, then intergroup cost of sales after deducting the UPS, then that is the value of the cost of sales. Distribution and admin and finance costs and the income taxes has no problem. Just pick the parent and the subsidiary, combination of the two. Then you get your profit before tax. Then profit after tax, remember to share the portion to the NCI by taking their profit after tax. You check the depreciation, remove, deduct the UPS, whatever remain, you share with the percentage of whatever they are controlling. Then you remove the dividends to the parent. You get profit for the year. Then you combine the profit at the beginning of the year in that account. Then you get your retained profits carried forward. Then you check the financial information, which is more important because that one will help you to not to go wrong when adjusting the subsidiary items. So that is how you can adjust your income statement. So see you in the next, how you can adjust the balance sheet items of a subsidiary. So thank you. See you in the next video as we look about how you can adjust the statement of financial position.